Hello and welcome to BloombergQuint. The bond markets had a crazy week last week. Actually, it's been a tough month. There's been a lot thrown at the markets, global factors, the Fed, oil, budget, higher borrowing program. How is all of that going to settle into the markets, and also a bigger view on what the RBI's priorities should be? Jayesh Mehta is joining us here for all things RBI, bond markets, and debt. Thanks so much, sir, for taking the time to speak to us.
My pleasure. But as you said last week is just the beginning.
Oh dear. Okay, so that's my first question, sir. Firstly, what happened last week? Was it just the complete disconnect between what the market was expecting in terms of borrowings and what came, or was there also an element of positioning which then sort of got corrected after the budget?
No, I think market was quite convinced about two things, right? One was the expectation that it won't be higher than last year, which is 12 lakh crore gross borrowing. And then plus 12 plus 10 lakh of state loans. So you have 22 lakh crore. And even with 22 lakh crores, you would require some RBI support unless the capital gains thing on the index, the requirement for Euroclear comes in.
Yeah.
So I think there were a lot of players, of course there was some positioning also, there were a lot of players who were quite sure that would come through, right? And if that would have come through by maybe June, July, August, maybe the second half, that could have absorbed the extra supply which was coming into the market. So I think both the things were, negative for the bond market. One is the number moved from 12 to 14.35 or whatever it is. And of course, this tax thing didn't come. So now index inclusion, I think it may eventually happen, right? Even without the tax thing, because, as and when you want to go into it, I'll dwell on it, or maybe I can start it right away. It's like, I personally don't believe that, Euroclear is a must for index inclusion, because yes, but the index providers have been saying that, if you look at it, everybody has been saying that, okay, fine, you want to be part of the bond index, emerging market bond index, you have to be part of Euroclear. I think if one looks at the system per se, I would say it's really not required. Look at our equity market, right? We are part of emerging market indices, right? But we are not part of Euroclear or anything. We have all settlements happening in Mumbai, in India. And there is also a time change, right? If you look at it, equity market, how it evolved was you had ADR, GDR, and all that, right? Because earlier cross-border transfers, your own local settlement systems, and all that were not so great, right? Today, if you look at our settlement system, it's definitely the best in the world, right? Like it's like great settlement system. Cross-border transfers are as quick as possible. Everything is. So I don't really see why you need something. In fact, it is disadvantageous to the investors, because if you go to Euroclear, it's a limited pool you deal with, right?
Yeah.
Whereas here, when you are dealing onshore, right, you are dealing with a much larger pool, including mutual funds, insurance companies, provident fund. You're dealing, your market size is much bigger. So I think, we need to really, really push for it. Even without Euroclear, why shouldn't we be part of the index? But that, now that is the new way of negotiation. It may take, we don't know what
we don't know how long it will take. I'll come back to that in a minute, sir, but I just want to focus a little bit on the borrowing side. So at about 14.9 was the number, and apparently they hadn't adjusted for the switches that happened, so a little bit lower than that. Is there going to be a serious absorption problem, assuming that this global bond index demand is not yet coming in? Is it going to be a tough year that way?
Yes. So, I always had this theory. If you look at it, whenever we have even normal borrowing program, forget the higher borrowing program, we have three sets of players who mainly absorb the borrowing program, which is insurance companies, banks, and provident fund, right? Now, with this three set of players, the supply is more than what they can absorb. So you always need the fourth guy. And the fourth guy, if you look at it, in a good market, you have either SBI or you had Reserve Bank of India. And generally, if you look at past 5, 6, 7, 8 years or so, when FPIs are buying bond, RBI need not buy bonds, or actually they are actually buying dollars, so therefore they are buying dollar assets. And like when FPIs are not buying bonds, naturally RBIs don't have dollars, and therefore they are buying rupee assets, and therefore that was getting meshed. Of course, last 2 years when the borrowing program is heavy, they had to go out of the way to accommodate and buy the bonds, right? Um, so that's where the challenge is. So you need the fourth buyer. Now, who's the fourth buyer? So one was this FPI, who's like very much tied down to the index situation, otherwise not coming in. And let's be very clear, because if you really look at the bond guys per se, unless it's part of index, they are more, it's an FX play rather than a bond yield play, right? So it's an FX play. So if people don't, unless you have suddenly the bullishness on the rupee and everybody is gungo about rupee and this guy. So for the foreigners, it becomes an easy way to go long INR, short dollars, is to buy bonds, right? So, but that is not happening right now. You are talking about dollar strengthening globally and stuff like that. So that's not happening. And therefore we need that fourth buyer. So FPIs are out unless index inclusion comes in for the timing. Of course, the things could change, right? Then you have RBI. On RBI, last 2 years, whatever they bought, we have pumped in so much of liquidity. We were on the mode to, slowly, gradually, and not shocking, but gradually bring that liquidity back to normal. Or maybe even if it, bring it back to 2-3 lakh crores per the day is also fine, right? But that would have been the, game plan, right? Now, with this situation, buying more bonds, which they will have to, because they are as I said, like the fourth buyer, right? If FPI is not there. So they will have to buy somewhere. We don't know when. They will have to think something very innovative. And as I said, like earlier also, like they're not in an envious position, right? So either they will have to really think out of box. Maybe at some point of time we did CRR with interest, and at the same time buy bonds, something like, I don't know what they can think of, right? So it is really, they will have to come something very, very innovative. So that's a big challenge.
Because logically, sir, at this point, it's very tough to justify them buying bonds. No, in fact, they've been selling a little in the secondary markets, because that is the direction that they should be moving in. Switches, I don't know how much they have in terms of short-term securities now that they've done this large government switch as well. So what's left for them? I mean, how will they justify intervening in the government bond market right now?
Let's be very clear, right? So I don't think in last 2 years people need to justify buying bonds.
That's last 2 years. Now things are a bit more normal. Now you have to go back to original framework.
But the borrowing program is not normal, right? So you will need that fourth buyer. So as I said, FPI, we don't know. At least for next 6 months, we don't know, right? It could happen after that. We don't know on that situation. Till that time, our dependency is on RBI. And of course, there is a great thing which they have launched recently, right? And I would like to take some time there on that particular RBI retail gilt direct, right? Firstly, of course, I keep on jokingly saying that I don't know whether have you tried opening that account. So
I haven't, but I should.
And I would encourage everybody to try and open that account. It's some magic. It's some magic. Like, we haven't seen anything like this in India. It's like, you don't need your photograph. You don't need your PAN card as in PAN card physical copy. You don't need your Aadhaar as in Aadhaar physical copy. You don't need any physical copy. The only physical copy you require is your bank account, photos sized it down to 500 KB, and your signature on a blank paper sizes down to 500 KB. That's the only two things you require. You put in your PAN number, they take your permission to access eKYC, right? And they bring in eKYC, they bring in your savings account details and ask you to confirm that, right? And then you have the Aadhaar OTP, and then they credit some 1 rupee something in your savings account.
Yeah.
That's it. You're done. 7 minutes. It doesn't take more than 7 minutes. So it's a great system, right? And I actually jokingly say either the RBI is not following their own KYC norm, or the banks in India, okay, have not understood the RBI KYC norm. Because I can tell you, forget opening a new account, even doing a KYC refresh, right? No bank can do that fast. So it is an amazing system. It's a great system. And of course, right now it's in trading on a different mode, which is the NBS retail and RFQ system. Maybe at some point of time, we should merge it like equity. Like on equity exchange, you have one share of Reliance or 100,000 shares of Reliance, all trading on the same platform. I think with current technology, we should do away with minimum 5 crore lot and all that, basically bring both of them on the same platform. So it's a wider market on the same platform. So that's one part. The challenge, of course, is the incentive on as the deposit rate starts going up, this becomes unattractive. And we always had this problem, unlike other markets. And it's not only about gilts or debt or anything. It's not about bond market. It's about financial market. It's like, wherever the world financial market is developed, you have the lowest rate as deposit, followed by government bond and followed by corporate bond. We always had the reverse situation. The lowest was government bond, followed by corporate bond, and then the highest was the deposit rate, right? Which has changed in a couple of years, and that's why you see a lot of financial assets growing, right? From that perspective, we have to see. But yes, you do require some sort of incentive for retail. I'm not asking for much. I did see your interview with finance secretary. For him, it was like saying from one pocket to another, but encourage a new market or a new market segment. Even I would say as little as, because it's retail, I'm not asking for high net worth and all that. Even if for retail, if you say 3 to 5 lakh as an ATC on interest income earned or something like that, that would go in a long way, So I think from that perspective, that guys can become a fourth buyer.
But in a while, sir, in many, many years. Right now, the RBI doesn't have that comfort at all.
I'm saying even if you do the tax change and all that, nothing's going to happen before 6 months, right? I'm saying, you are saying why it is why, but I'm saying assuming even if it is 6 months, right? What happens in next 6 months? So our dependence is completely on Reserve Bank of India.
Okay, so hypothetically, sir, if the Reserve Bank of India doesn't come in a big way to support this program, plus what is happening globally, we haven't touched on what's happening globally. Fed perhaps launching one of its most aggressive tightening programs, oil prices going where they are. Where do yields go from here?
Don't know I don't know. Honestly, I don't know. Like, unless wherever RBI decides to draw a casting line, right? This is what exactly we talked in early 2000, right? And then they got it right, and there was some August, September, and then finally, okay, RBI did draw a casting line. So again, it's the same thing. Wherever RBI draws a casting line. See, I think markets find
7 plus.
Yeah.
Easily.
Given. That is done. So I'm talking about whether it's 710, 725, 740, 750. I don't know. Wherever RBI draws the casting line, that's the
bereft of RBI, it can go as high as 750, you think?
It's not right now.
Not right now, I mean.
Borrowing program starts in April. Every week you would have almost like 45,000 crores borrowing. May, June, July, I think would be the worst timing, right? So by that time, your incremental, as it is seen, last 2 years also banks have bought a lot, right? So it's not, they are just on their SLR. But of course, credit's not picking up, but that's also moving, the cycle's changing. So we definitely need that fourth buyer. And as I said, like as we discussed, FPI and retail is far away, and the fourth buyer has to be RBI. Otherwise, the mess does not match between the demand supply.
How much of the current, sort of yields in the market are building in normalization of policy locally? So, for instance, if this week we get a reverse repo hike, 20 basis points, just normalizing the corridor, will the market react, or is all of that built into the market now?
That's built in. I think a reverse repo, 20 now and 20 maybe announced it, later on, maybe, coming back to 375. That's kind of built in, right? Of course, the swap markets have built in more than that too. So they have kind of built in like 3-4 rate hikes and stuff like that. I personally don't see we are in a hurry to do any rate hike, right? So unless the oil goes to maybe 100.
You're talking about repo now.
Repo. But yes, the normalization of this hopefully should happen maybe in this policy, or maybe they will announce it with just like, when they used to do CRR, starting date from so-and-so date to so-and-so date or something like that. Something of that sort is the expectation of the market. That's built in. So that's not a challenge. But I think repo rate hike is built into the swap market. But as of right now, yes, yeah, people are talking about nothing in this policy, but maybe some people are in the next policy onwards to every policy, and some people are beyond that. I'm not too sure on that.
Does the market think the RBI is behind the curve?
Market, more than market, I would say.
Or do you think the RBI is behind the curve? Let me ask you.
I don't think so. I don't think they are behind the curve because let's be very clear, and I think Governor also had mentioned earlier. If you look at, we are comparing everything with US, right? So their target rate is 2%. They are at 7%, right? Our target rate with flexible target rate, we are 2 to 6, like the median to be 4. We have decided we will focus on the growth, and therefore the median 4, we will chase it in some time in future. But right now we work with a mandate of 2 to 6, right? And at 2 to 6, I don't think unless oil goes really, really high, nobody is predicting, sustainable over 6 at this juncture. So from that perspective, I don't think they are behind curve. We don't know what's happening what will happen in May, June, July. But at this juncture, definitely, if you look at the most pessimist guy on the street and ask him on the inflation, nobody is really, maybe one spike above 6, maybe, but not really sustainable basis above 6, unless the crude goes in a crazy way.
How will foreign investors view India if, for instance, there is wide-scale normalization, not just the Fed, other central banks also start to follow the Fed and normalize their core policy rate? India is a bit of an outlier. How will foreign investors view that?
Firstly, they are not having any view at this juncture on the.
They are not coming in many cases.
Yeah. So from that perspective, but yes, they do exercise their view on the currency. And at this juncture, people are surprised, like, wow, the rupee is showing quite a good strength, like in spite of so much of supply. People are surprised. But yeah, as of right now, I would say they're not expressing the view either side on currency nor on bonds. So they are kind of, at this juncture, not really looking at it. Of course, they have other markets to bother about. Because some markets which are not there, why bother about that, right? So from that perspective, yes. I think one of the things which I'm not sure you're going to ask is like with the Fed going up and all that. But yes, so something which we are seeing very different on the equity side, which is like so much of sell-off getting absorbed by local guys, right?
Yeah.
For us, we really haven't seen foreigners in it, right? So for us, there is no, like if you look at 2013, that time, just newly, if you look at it, 10th May, we announced 5% withholding tax. So from 20% withholding tax to 5% withholding tax. And therefore, there was huge position built up on the FPI debt side and stuff like that. And then 22nd May, taper tantrum started. So we had huge debt portfolio sell-off. We don't have that portfolio. So what is the point of that sell-off? So we don't really look at it much there. The good part which could happen is, I don't know, good or bad, but something which can happen is like if dollar strengthening happens with US tightening, and if rupee weakens with so much of reserves, RBI would intervene in that. And if RBI intervenes in that, that kind of manages their flows, and therefore that will give them room to buy government bonds. So, but that's again, it's all if and but, right? At this juncture, market will look at, okay, fine, where are you supporting it? Like, which is the rate you don't want to go it, let the bond yield go above that. So that's what market is going to look at.
What on liquidity, on the liquidity side as well, sir? So, I mean, apart from the sporadic sales that they have done apparently in the secondary market, are you expecting any major change in how they tackle liquidity at this stage? Right now, they seem to be, convinced that the VRRRs are the best way to go or the least disruptive way to go.
Yeah, I think so. So I think the only thing is, one, the market would expect, like, let's have a stability. Let's not keep on changing that thing. So then once it is stably known that, okay, fine, this is what we are doing, maybe 7 days, 14 days, whatever it is. So let's not kind of play it around, sometimes doing 3 days, sometimes doing this. So that kind of disturb the market, because then you don't know. See, I think when the rates are going down, when liquidity is being injected, whatever you err, either on communication or whatever it is, people take the most optimist view and deal with it, and anything there gets absorbed pretty well, right? But when you are on the other side, right, when you are raising rates or when you are removing liquidity, people would take the extremist view, right? So because unless you communicate well, you communicate intent well, what it is, and follow by the action, right? Just not the communication, follow by the action. Otherwise, people will say, okay, fine. Now that it's just like, okay, you did a one rate hike, or now like US will start doing series of rate hike. We'll do, we are going into tapering. We are going into, we'll replicate everything what's happening in US, right? So people can go up to whatever they want to think. So that's where communication becomes very, very crucial, and action, of course. Action needs to be very crucial. So market's going to wait. So we don't know how it's going to pan out, but it's going to be wait and watch. Nobody's going to take new. But of course, fundamentally, if you think your medium-term inflation is 4, 6.5 is a great rate, right, for 10 years. But this is all demand supply. So maybe next 6 months is, I would say, still even July. It's a difficult period.
Difficult period. So last word then, sir, come MPC review, you would want to see clarity on communication, on some sort of path on normalization. What would you want to hear from them that would at least, sort of prevent the bond market from reacting even more dramatically than they have, I guess?
I don't know. Honestly, it's not as I started with, it's not an enviable position, right? They can't do any action right now. Maybe they can give some verbal comfort. That verbal comfort will be worth 5 basis points, right? So, but yeah, the path on regularization, that does not mean maybe some comfort. That doesn't mean that it's a repo rate hike. Repo rate hike would be dependent on the range and stuff like that. That sort of assurance. But ultimately, whatever you say, good, positive, ultimately, it's the pain's going to start when the April supply starts, right? So from that point of time, it is going to be when the market is going to work. So even if you do something great today, it's going to get, okay, fine. Okay, it's good for next 1 week or so, right? But then what about 1st April when the new borrowing starts? So I think that's where the challenge is. And as you said, like, they are not in a position, I don't know, but they can, or they don't know, but they won't do it. I don't know about it, but they are not in a position to give you OMO purchase calendar.
Exactly.
And all that. So I don't think they would give it, and not market is expecting. But so at some point of time, market will look completely on RBI. And as I said, like, market can find the price and value when it is normal. When it is on the extreme side, you always need central bank to, both sides, central bank to define or put a cap and collar.
I think you described it best in the beginning, not in an enviable position. Thanks so much, Jayesh Mehta, for taking the time to speak to us on all of this. Appreciate it.
Thanks.
Thanks for watching Bloomberg.